Thank you very much, Mr. Chairman. And before going back to my first question with the witnesses who didn't get a shot at it, I do want to try that, but I wanted to follow up quickly, Mr. Pollard, with you on the question of loan limits. As I understand it, your explanation is that there's a loan limit and then there's an authorized maximum amount of loan that will be authorized as the entities are managed. And I get that. There is, as Senator Menendez indicated, a continuous debate here in Congress about what we should set as the loan limits. But I would wanting to give you an opportunity to get into the policy considerations about why we should or should not be setting the maximum authorized loans at this point at the highest levels possible or at the current levels that are being discussed.
Right. I don't think the issue is whether Congress has set them. I think the issue for me, and trying to be the person who avoids the director doing anything arbitrary and capricious, is that the maximums, the language in the statute begins with the enterprises shall set limits. It says this about 3 times, and then only says that the maximum limit should not exceed.
Right.
So the policy behind this right now is, and I should have had a chance to say to Senator Menendez, and I apologize for this, that we also have a policy to try and reduce the footprint of the enterprises in the marketplace, which stands at 75% of the entire domestic mortgage finance market. And this is part of an effort of several steps. We're trying to do new credit risk transfers that are recognized in S-1217 to share risk. We're talking about a 10% insurance type approach with a first loss. All of this is to bring in more private sector and restore more of an equilibrium and reduce the burden on taxpayers. So I think that's part of the coordinated effort. We certainly have heard the debate on this. The director is very sensitive. He said there would be tons of notice, very sensitive to how the market would adapt to any change. And again, it's under review and you know, it has not occurred yet.
Thank you. And before I get back to my first question, I want to quickly ask you, Mr. Regner, what, in your role as the Assistant Director for the Arizona Department of Insurance, I'm sure you've dealt with a myriad of issues affecting mortgage insurance, from undercapitalized private mortgage insurance companies to regulatory interaction among various entities at both the state and federal levels. What specific powers should the new federal regulator have to effectively deal with the private mortgage insurers in a reformed housing finance system?
Well, before I guess I answer the question, I think from our testimony that I gave today, that we feel that the powers or the guidance that is directed within the bill, that the solvency and capital standards should still be maintained and regulated by the states. In order to maintain a capital level that is adequate to allow for new entrants and for the continuation of a competitive market. Capital is very expensive. When you get into areas of getting into being excessive, the possibility of the loss of entrance or the continuation of that line of business could be lost. That's some consideration you may want to think about. And of course, the NEIC staff would be more than happy to work with you in regards to maybe coming to some sort of resolution to that type of concern that we have.
All right, thank you. And now I'll just get back to the 4 of you who did not get a chance. If you choose, if you'd like to respond to my first question, which was really the broader question of how do we solve this issue of creating a very, very, what I see as extensive and powerful new regulator in a field where we already have very significant regulators playing in a number of different positions. And how do we make sure that we give appropriate authorities to, but assure that we don't simply pile on, if you will, the regulatory level of burden that we have put on our housing finance system? Would any of you like to jump into that?
Sure, I'd be happy
Ms.
to.
Ellis?
Sure. Sure, I'd be happy to share some of our experiences at the FDIC, hopefully it'll be helpful. The FDIC has a long history of working with other regulators, both at the state and federal level. We are primary supervisor for some banks in the U.S., but we are a backup supervisor for other banks in the United States. And where we are backup supervisor, we have well-established protocols, some facilitated by statute, others facilitated just by informal agreement among the agencies for things like information sharing, the sharing of examination reports, participation on examinations, And even when it comes to disagreeing over the condition of institution, we actually have protocols for how to go about disagreeing. All of these are important to reduce the duplication that goes on, as well as the confusion that it could cause to the regulated entity.
Mr. DeZivi?
Yes, Senator. I think one of the key methods of increasing the efficiency of the regulatory structure is the sharing of information. And there are provisions in the draft legislation that permit sharing of information, but Congress may consider actually requiring sharing of information because sometimes agencies like to butt heads a little before they turn over each other's documents. So that might be one thing for Congress to consider.
Thank you. Mr. Couch?
Senator, I can't add to the other witnesses have adequately described the cooperative systems that are in place now, but I would compliment you for thinking about it because it's important, and I think it should be covered.
Thank you. Mr. Regner?
Just a quick comment. Information sharing is very important to keep that avenue open so that we can learn off each other's experiences and all the work that we both have put into the efforts of looking at these type of industries.
Mr. Leonard?
Senator, just one more point on your question. For example, in the area of mortgage servicing, I think there is more that could be done to improve coordination of, particularly in loss mitigation requirements. And obviously, there was a need for improved loss mitigation because servicers did not have adequate standards, as we found out during the crisis. But now you have multiple standards. You have making home affordable, you have the National Mortgage Settlement, you have the OCC consent agreements, and you have CFPB and GSE guidelines. In some areas, many of these are coordinated. In others, the requirements are slightly different. So servicers are operating, in time, like, for example, times where you have to, the number of days you have to respond to the customer, things like that. I think as you look at a bill like, for example, on servicing standards, additional thought about how the agencies can coordinate. And it's moving together, but there's still, what we hear from servicers, that there are a number of different standards still vary, and it causes some confusion. So I think it's an area that still needs to be looked at. Thanks.
Thank you. Mr. Pollard, you get the last word.
Thank you.
Unless the chairman wants to give somebody the last word.
He's certain you two will have the last word. I want to be sure that something's made clear, that a lot of us have used terms today, and I want to be sure I'm clear for the committee on our perspective. We talked a lot about setting standards in the market. I think it's very important to recognize that third-party service providers are very important, and any regulator that's providing a service like this has to be able to look at them. They do pose potential risks, so people's one step away from the person you're dealing with may be very important. And I think that's one of the things we're talking about. I don't want to mislead the committee. We think that ability, that capacity. And second, when you're putting federal taxpayer dollars on the line, I think there is a challenge to address the reach of the federal authorities here. They need to be broad. We are talking about putting federal tax dollars on the line and the ability of the federal government to be able to look into, to track, to set standards that may affect all regulated parties within this framework, not expanding it, but within the very area we're talking about. Just this area is part of an interesting point that I do think needs to be addressed and confronted.
Thank you. I'm sorry I went a little over there, Mr. Chairman.